Hello and welcome to SF Live. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. Thanks so much for joining us. We have a very timely conversation lined up for you today, and we'll be joined by Sam Broom. He's portfolio manager over at Sprott Global down in the US, and we're going to talk about all things Fed related, gold price, silver price, of course, what is happening, some of the investment themes he's looking at, what is he maybe recommending to his clients. Due to compliance reasons, we're not going to talk stock picks, but maybe you can take some guesses and hints at what he's looking at. And of course, we're going to talk about US dollar weakness. What else? I have lots of topics lined up here: dividend stocks, recession, mining stocks. How does it all fit together? I think it's going to be a fun and very dense conversation here in the next 20-25 minutes here with Sam. Before I switch over to my guest, though, be reminded, follow us on YouTube, follow us on Twitter, hit that like and subscribe button, and leave a comment. Helps tremendously with the algorithm. And of course, we want to hear from you. What are your thoughts? How are you investing in this recession? And where do you see things headed? And one last thing, join us in Frankfurt, DEUTSCHE GOLDMESSE, November 18th and 19th. We've got 35 fantastic companies, 6 amazing keynotes joining us, free to register for investors. Make sure to use that opportunity to meet the CEOs and look them in the eye and feel their pulse, see what's happening. So enough of me. Jeez, I talked a lot of words in a very short time. Sam, it's great to welcome you on the program.
Yeah, thanks for having me. Great to finally be here.
I've been meaning to do this for a long time, and we missed each other a couple, like over the last 2 weeks. We had to reschedule a couple times, but if I would have had you on 2 weeks ago, it would have been a very different conversation than it probably will be today. So thanks for making it happen. Really appreciate it.
Yeah, no problem. Thanks for having me on board. It's great to be here.
Now, and Sam, first time on SF Live. Why don't we start off with a quick introduction, and then we'll dive right into it.
Yeah, sure. I work at Sprott Global, which is the office down here in Carlsbad, California, that Rick Rule started, I don't know, 30 years ago. So I've been working alongside Rick and team here for the last 7 years or so. I'm a portfolio manager and have a book of private clients as well. Before that, I got a geology degree. I grew up in New Zealand, got my geology degree in New Zealand, and spent a number of years working as an engineering geologist in the mining sector in Australia before jumping across into the financial side of things. So a little background from me there.
Fantastic. So you're dangerous actually on both sides of the table. So
dangerous indeed. Yeah.
Fantastic. Yeah. No. Let's dive right in, Sam. Let's not lose any time. But I've noticed you're quite active. Obviously, on you were quite active. Let me state that. Like you were quite active on Twitter as the nude investor. And I've noticed your Twitter activity sort of started dwindling around mid-March, around the first Fed rate hike. You want to explain why?
Oh, there are numerous reasons. I can't give away my trade secrets. It's all and sundry, right? But no, I mean, it's compliance, stuff like that. It's hard when you're managing real money to have a social persona, I guess. It's just there's a lot of hoops you have to jump through. So a lot going on in the background.
Markets.
Markets haven't been that fun over the last 6 months up until the last few days, let's be honest, but it's all part of the fun, I guess.
No, because like one of your last tweets was March 24th. I think that was 8 days after the first Fed rate hike. So I thought there was a correlation. That's why I was asking.
Is that right? Gosh, has it been that long?
And then it's only been like 3-4 tweets since. So it's been fairly quiet. That's why I was asking, like, is there a correlation between what the Fed has been doing and your Twitter activity?
There's just so much value there in the background now. I'm too busy running all my models and looking at what I want to buy. So there you go.
Oh, fantastic. No, it's like, as you can tell, everybody's like, it's a quite cheerful conversation because gold is up like $100 over the last 2 days. Silver is trading at $21.19, up like $3 over the last 2 days as well. So quite a positive mood. It looks like stocks are behaving quite well as well. What do you make of that trend change? And like, where did that come from all of a sudden? You must be getting inundated with calls because investors like myself are just puzzled by that sudden turnaround.
It's funny, isn't it? I mean, I remember on Friday looking at across my social media landscape, emails or whatnot, more general market stuff. I think precious metals miners actually had a decent Friday, but it was like max fear on Friday. Everyone was looking at things like these Credit Suisse default swaps going parabolic and, predicting we were going to have a mad crash this week, Monday. And then all of a sudden you wake up and, everything's massively green and what feels like a major trend reversal. The markets are funny things, right? When everyone gets positioned way to one side, it has a funny way of inflicting maximum pain. When everyone's short, these sorts of things tend to happen. There's a heck of a lot of money on the sidelines. We know that. There's a fairly extreme positioning to the short side in a lot of sectors, not specifically mining here, but financial markets in general. There is a lot of fear. You've got to remember, even bear markets tend to have the most face-ripping rallies, right? I mean, I think something like 7 of the top 8 rallies in the Nasdaq occurred during that 2000 crash, right? So it's definitely positive, but it's not uncharacteristic to have these kind of face rippers, counter trend rallies across financial markets. So I think we are seeing market participants taking advantage of that extreme positioning. I will say, specific to the commodity markets, in particular precious metals, I have noticed there's been somewhat of a early signs of a decoupling from the broad risk-off sentiment across markets. I mean, there were a few days last week where the Nasdaq, S&P, etc., were taking an absolute pounding, and gold and the miners were positive. Which it's not, a few days isn't a trend, but I have noticed that a few times occurring over the last month or so, which is usually a good sign. I do remember noticing that a fair bit back in, say, 2015. Again in 2018, which is the last time we were sort of down in the absolute dumps like we are now. So it's definitely not a bad sign. And in terms of the sectors that have been the most beat up, I mean, you look at positioning, across the metals markets, particularly precious metals, things like copper. You look at something simple like the commitment of traders reports, right? And we're at historic levels of positioning, either to the short side or lack of long positioning, which does mean there's a heck of a lot of money sitting on the sidelines or short that needs to cover or come back into the market. So, look, this is the first positive move. I'm not going to count my chickens just yet. A few days does not make a trend, but it's definitely green shoots. So I'm certainly watching closely.
What are some of the signals you're looking for now in the next few days, Sam, to make sure that is actually a trend change, or is it just a timing thing, just a time thing, actually?
Yeah, I mean, frankly, what I don't want to see is an absolute face ripper. I would much prefer we backfill methodically and sort of grind out. Today, for example, there's a big gap up in the GDX. I'd love to see that backfill and not capitulate and slowly grind higher. In my experience, not always, but in my experience, when you have a sustained downtrend like we've had in the precious metal space now for a couple of years, it's rare that you get an absolute ripper of a V bottom. You usually have to grind away at the negative sentiment and kind of create the conditions for a sustained bull. Not always, caveat, not always. Sometimes it does rip out of the lows, and frankly, I'd take that too. But I would much rather we get a nice tradable low that grinds out some of the bearish sentiment, and then we start seeing a more sustained rally, something like almost like a 2015 bottom. That was kind of textbook, because we have had a proper sort of sustained bear market. This isn't like March 2020 where we had 2 or 3 weeks where it just liquidity driven collapse, right? We have had a proper sort of correction that morphed into a bit of a bear market. What I think is probably going to end up being a little mini bear market here. But signs are good so far. The last few weeks are looking decent. So
No, absolutely, yeah. It's been a really dreadful decline ever since August 2020, I think. So it's just painful. I haven't seen too many days where silver is up 8-9% in a day as well. Like that was,
yeah, it was like, I think it was like the 7th or 8th largest single day advance in silver's history. So I think going back to out of the lows of 2008 was the last time we had something of this magnitude. So obviously that boded well for the next couple of years. So look, silver is a classic example, right? I mean, there are a lot of conspiracy theories about manipulation and whatnot, and the sheer the absolute dominance of the paper market over the physical metal, which is very hard to argue with. I'm not someone that buys into the mass conspiracy theories, but if you just look at the way the market is structured, it is a very financialized market. And unlike something like oil that's consumed, the paper markets can dominate the precious metals market's price action for very long periods of time. And at the moment, the positioning is extremely one-sided to the bearish side, and the conditions are there for a sustained rally when that speculative money flips to long again. So look, I'm, all sorts of stuff on the silver space looks quite constructive. The gold to simple stuff like the gold to silver ratio, commitment of traders reports, just the sheer destruction we've seen across equity valuations in the last couple of years, particularly the last 6 months. It's a very contrarian bullish setup, and we all know to make money in the commodity markets, precious metals in particular, you do have to be contrarian and force yourself to be a bit of a buyer. And even just looking around my social media too, right? I mean, people were, it was pretty bad out there. Probably the worst I've seen it, the last 3 or 4 months. So.
Oh, it's been brutal out there. Like mood all around has been just dreadful, right? But I don't think, like, I had a few discussions with people on site visits as well. Didn't feel like we've seen the complete capitulation event yet, where really people just like, okay, I'm done. Like where they left. Like we haven't seen that. I felt like that's why I was a bit surprised to see the rally now at this time.
Yeah, I mean, capitulation's always a hard one to figure out when it's happened, right? I mean, sometimes it's easy. You see huge volume come through. To March 2020, there was just ginormous puking volumes on like I think we had a 19% down day in the GDX on like biggest volume in forever. So sometimes it's easy. I think this bear market has been tougher in that it's been such a grind. We haven't really had like you say, I mean, I guess you'd call it a capitulation moment where everyone just pukes. But I think it's kind of been more of a war of attrition, and it's been a slow, steady trickle of people just getting fed up with the space, frankly. So you go back to like the 2015 lows, it was similar. Like there wasn't really a mass capitulation event. It kind of there were moments that felt almost like that, but it sort of hit a bottom, ground out a low, and then just turned. So I think there are similarities to 2015. Again with 2018, both of those moments also correlated with hiking cycles, right? So there are those similarities too. I'm not game enough to pick absolute bottoms, and I've been in this game long enough to know that that's mostly a fool's game. But what I do know is it's definitely the best. They're the most attractive valuations and buying opportunities I've seen since at least 2018. It's possibly on par with 2015 if you consider the fact that the gold price is, $400 higher or $500 higher than it was back then. So if you think we are bottoming here, I mean, there are some pretty attractive valuations out there.
No, absolutely. Like when gold broke that technical support level at 1675, though, we didn't see that mass capitulation happen. I think, right? Like as I mentioned, like I didn't see it. I didn't like even the stocks held in reasonably well when that happened. When gold broke to the downside, like.
True, but a lot of them had already, a lot of these gold stocks have already taken an absolute hemorrhaging, right? I mean, gold, at one point I remember looking, gold was down about 9% on the year or something like that. And, the miners were down. I think the miners were down about 25 to 35% on average. But when you consider they were up 30%, mid-April, that's a pretty big swing, right? And a lot of these miners are, pricing sub 1 times P to NAV, and these are the quality miners, these are the best of the best, right? Usually those guys are trading 1.5 to 2.5 times NAV, street consensus NAV. So we're already at levels that I haven't seen in my career and these are the quality best of the best big boys, right? We all know there's a lot of crap in the space, but these are the best of the best. So I haven't seen those levels of valuations in my career, which is what has got me interested.
No, absolutely. It brings me actually to the next question as well, and it's dividend stocks actually, because I've seen like a Barrick and a Newmont trading at 5% dividend yields, and at least like I've been in the industry like what is it now, 12, 13 years. That's a valuation I've never seen before, and dividend yield I've never seen from any of the big miners. Twofold question: like, what's your opinion on dividend in mining companies? Are you seeking further? Like, is that part of your portfolio strategy? And are mining dividend stocks even worth looking at?
Sure. Yeah, it's a good question. I would probably never own gold mining stocks primarily for the dividend. I don't think owning gold stocks for a dividend should be your number one reason for buying gold stocks. I think, given the nature of the business, you want to own gold stocks because you have a bullish view on gold, and it's the greed part of your precious metals portfolio where you're looking for, levered upside to the gold price. However, in times like these, where these especially these ultra high quality, the best of the best gold miners are trading at such cheap levels, still generating, very attractive cash flow yields, much higher than, say, the S&P 500 right now. It doesn't hurt if you buy the miners with the lowest end of the cost curve, and you do your work and make sure you think the dividends are sustainable, right? Because that's key. If the gold price absolutely collapses, what we often see in bear markets is these big dividend yields are then cut, and then you end up, the stock's hammered, the company cuts their dividend and gets a second wave of getting hammered, because these are very capital intensive businesses, right? So that's why you have to be a little bit careful buying them for the dividend yield. But right now, my favorite names are, I'm usually getting anywhere from 2.5 to 5% dividend yield on these big high quality, multi-billion dollar gold miners that I believe, and we believe, the dividend is sustainable under, most reasonable outcomes. Obviously, gold price collapses to $800, everything's off the table. But if you believe in a mid to long term higher gold price, these dividend yields do look sustainable for most companies. It is an attractive thing to buy, particularly in certain times, right? I mean, right now, I do think the price action looks bullish, but no one really knows. You're watching, waiting for a more sustainable sort of turn and rally, buying a best of the best company, paying you 4 to 5% to sit there and wait, and is an attractive option to me, especially considering I think there's a lot of upside on the equity beyond the dividend. I'm not buying them for the dividend, but it's a nice little sweetener while I wait.
No, absolutely. Two birds, one stone. I think situation there as well. For at least for the very large caps, the high quality premium ones you mentioned. Actually, the dividend discussion brings me also to the next question as well. Like, are you more of a growth or more of a value investor in that regard, right? Do you want the Barricks and Newmonts rather to use their cash to go out and grow, where if feasible, or do you rather want them to pay the dividend? Like, what side of the fence are you on?
It's a tough one, because right now it feels like the market just wants capital returns, right? Most big companies that have gone out there and been aggressive and bought something, they've been hammered by the market. I've got a couple of Aussie stocks that I've always loved that have come over the ditch and bought Canadian assets, and there has been some issues. This wave happened right in the middle of COVID, so they had 18 months delay in getting to site and getting their teams to help transition these assets. But man, these stocks have taken an outsized walloping for showing some, investing in future growth, basically. So the market is right now is not paying management teams and boards to put their money into growth. But that's also part of the bull case, right? I mean, we've had this absolute lack of investment in future capacity, and this is applicable to all mining sectors, not just precious metals. Here you can see the same thing in the copper space, the uranium space, take your pick. So I have an appetite for both. If a company has just invested and has a good growth pipeline, I'm more than happy to take some capital return to shareholders in the form of a dividend. You got to be careful though, because if you do that, and mining is a depleting business, right? Unless you reinvest a portion of your cash flows and replacing reserves, you end up in major trouble down the line, and you end up not being able to be opportunistic, right? You end up with your hand forced, often at the top of markets where all of a sudden the market does care about growth, and that's when the poor capital allocation decisions come in. So right now, when everything is depressed, I think there are opportunities out there that management teams should be looking at on the acquisition side. I mean, there are some development names in the US, for example, that we track that we quite like, that are trading, 4 or 5 million ounce, 3 to 5 million ounce deposits, sitting in good jurisdiction, trading for like 50 million US market cap. And these things were multiple $100 million market caps just 2 years ago. So as a rounding error on your interest expense for the year, you can go and pick up some of the stuff as almost a free option. So that this is the time where they should be going out and looking for stuff. The problem is there is still a dearth of particularly tier one assets. I mean, you look at the discovery rate across just about every commodity out there over the last 10, 15 years. I mean, there's just been very, very few tier one discoveries, very, very few, which is partly why we're so bullish on the long term. But it does make it hard for the big boys, like you mentioned, the Barricks, the Newmonts, to find acquisitions that are material to them, at least in the development space. They almost have to go out and acquire whole companies at this stage.
No,
So
and maybe as a follow up to your question, is there a reason we're not seeing any M&A? And I've been speculating a little bit. Is that the valuations are so depressed that no sane company CEO or chairman would even take a 50% premium right now?
Well, yeah, I mean, it depends, right? I mean, if the acquiring companies using their paper, I mean, their paper is just as beat up as everyone else. I mean, like I was saying, a lot of these big seniors are just as beat up as the juniors right now. So if they've got cash on the balance sheet, I think companies with cash at the moment or liquidity have the huge advantage right now, because they can go out and use their cash to buy stuff. They don't have to dilute with their own depressed paper. So I think there is an opportunity. I think we will see a few deals emerge here in the next 3 to 6 months on that front. But yeah, like I said, CEOs have been, companies have been taking a beating for investing in growth and making acquisitions. Some rightly so. We have seen a few deals so far this year, and I've sort of scratched my head a little bit on a couple of them. But by and large, it doesn't matter whether it's a good or bad deal. Most deals have been punished in the market the last 12, 18 months. And I think management teams and boards are a little, career risk, right? It's the safe option to distribute capital back to shareholders. No one's ever your job's not at risk, increasing the dividend or buying back some shares. If you go out and make an acquisition that the market hates 6, 12 months, that's major career risk. So again, it comes back to what the market wants. At the moment, the market has no appetite for growth. It just wants return of capital. That will change, though. I mean, I wasn't in the finance game last cycle, but I'm talking to some of the guys here at Sprott that have been through multiple cycles. They tell me, 2009, 10. I mean, if you weren't spending on growth, you were absolutely hammered. Like, it's all the market wanted was growth, 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 growth. So when we get into a proper bull phase and attitudes materially shift, we are going to get back to a phase like that. We're just not there right now.
The sort of maybe last topic for our conversation is zoom out a little bit, and let's talk about what the market wants. And our conversation so far is very focused on precious metals, gold, silver primarily. What else, or what do you see does the market want out there right now? It's like, side note, whenever we do a green metals interview here and call it an ESG metal or something interview, nobody watches. Right, so I'm kind of confused by what the market wants, because the interest from retail in those green metals seems low. Lithium a little more so than others, but unless you have a gangbuster clickbait title, interest is still very hasn't reached general public.
It is interesting, because I have noticed a very distinct difference between the Aussie market and the North American market. For example, the last 18 months in Aussie, the lithium stuff's been going absolutely bonkers. If you want to see a market that's bucked the trend the last 12 months, go and have a look at the Aussie lithium names, and they've gone parabolic. To me, a little bit, the battery space has been a little bit overdone. I think there's a lot of narrative, and I do believe in it. I do think it's going to provide tailwinds for a lot of stuff over the next 20 years. But I think it's easy. It's too easy to just lump everything into the battery metal theme and not think about it in more detail and look at where the actual use case is, the shortages, where the real demand is. So I keep coming back to something like copper. It has been, there are a lot of copper bulls out there, but there really is a very, very sound structural long-term case for much higher copper prices. Absent anything but a major prolonged recession or depression globally, which, the demand side is very hard to predict, right? We are in a weird, funky time macroeconomically, but absent, a major recession that lasts many years, the supply side of the copper story looks, if you're an end user, it looks pretty dire. If you're a commodity bull, it looks pretty bloody exciting. Especially out 2024 and beyond. There's just the cupboards are bare. There's a massive supply cliff coming. No one, just like we said in the precious metal space, no one's investing in major capex projects. The countries, Chile and Peru produce 45% of the world's copper output. I'm sure your listeners are aware of what's going on geopolitically in that region. You throw on top of that this crazy volatile financial state we find ourselves in. Imagine it. Copper prices going from $5 to $3 in the span of 4 months, on top of interest rates going from 0 to 3, 4, 5%. That's hardly the environment that inspires boards to commit to multi-billion-dollar mega capex projects, right? So all this uncertainty just delays the required investment to maintain capacity, let alone grow capacity, if you believe the sort of green transition, net zero narratives. So I could see materially when the world gets over this current growth scare, and it's fully risk on and investment, I could see copper breaking out to new all-time highs. And I mean, last cycle copper went from, what was it, 70 cents to 450. It wouldn't surprise me if we saw another move like that over the next decade. But you can apply that same narrative to pretty much all the base metals. Same in energy. Energy is a little different because oil and traditional energy, oil and gas, is much shorter lead time to bring on a new well. A copper mine from discovery to first production, absolute best case, you're looking at 7 to 10 years for a small to medium sized mine that's easy to permit and isn't what I would call a mega cap project. But if anything major, it's like a multi-decade lead time from discovery to first production. So yeah, and the same, like I said, same applies to just about every commodity. So supply side is really bullish for just about everything. No, I don't want to come across as a perma bull, but it's just the case.
I fully agree with you, Sam. And the only joke like we had on the site visit the other day was like, well, we've been in a supply deficit. No, the supply deficit is 3 years out, and we've been saying that for the last 12. Right? So it's like free beer tomorrow. It seems like the same narrative, right? So it's always
yes
free beer
and no.
tomorrow. You put that sign up. I know it's like it's interesting, like the whole, like, because if you look at it, because the majors always seem to find a way to plug the holes. And one thing I know is that's an observation on my end is on the lithium side. I recently listened to the Q3 quarterly, I think, or Q2 quarterly of BHP, and I was impressed by how many big name clients they have on the lithium side, like who they're supplying, right? So it made me think, like, okay, where are they getting it? Like, just sort of the supply chain behind it, and it makes me think of some of the narratives of junior mining companies as well. It just made me laugh, actually, when I think about some of the narratives there. But
markets are crafty, right? I mean, and the cure, it's a Rick Ruleism, right? But the cure for high prices is high prices, and you do increase prices, you will incent demand from weird places that aren't obvious upfront. But if you go back and look at capex cycles, like one of the key things I look at for where we are in a given cycle, look at the capex the industry is spending. I mean, if you go back to 2012, right, there were huge amounts of money going into new projects, huge amounts of money going into exploration. You look at that graph today, it's like a fraction, right? There's no doubt we're at the low end of a capex ebb, and these are, mining is one of the most capital intensive businesses out there. Almost always, these periods of capex depressions are what gives plants the seeds for the next bull cycle, and the bull cycles almost always end on the supply side. It's very, very rare where you get a major bear market that results from perpetual supply decreasing, right? You get short-term blips, but it's not, decade-long cycles are not usually killed by destroying demand. It just doesn't work that way. So
no. Absolutely.
We'll
no, maybe as a last question there, Sam, as well. Like, and I don't want to hear individual names, but like, how are you playing like the copper space, for example? Like, there's billion-dollar juniors, obviously, but like, for me, it's very difficult to allocate capital if you want to play copper, right?
You're singing my hymn book. I mean, I'm probably, of all the commodities, I'm possibly the most bullish long-term on copper, and I find it the hardest to get quality exposure to. Really, really hard. on the from both the discovery junior exploration end all the way through to the big boys. I mean, there's literally, well, there's one Australian name that I've owned for clients, for a long time, and that's subject potentially to a takeover. So that's maybe about to go away. Beyond that, if you don't want to take on jurisdictional risk, there's very, very, very few options. Most of the big boys have Latin American exposure, right? Because that's where all the big copper discoveries are. Yeah, and they haven't been the big. When was the last time? I guess people will know Philo and stuff like that. There have been some really exciting new discoveries, but they're few and far between. They usually do come with warts when you dig deeper, and there aren't that many. One of my favorite ways, there is a royalty company that I'm a huge fan of. It's not primarily copper exposure that they have exposure to. They have other, potash and a few other things, renewable energy. But I don't mind, the royalty space. As everyone knows, it's kind of a risk averse way to gain exposure to these commodities. They aren't trading at silly levels. Sometimes the gold royalty names are, obviously super high quality names, but they trade at very punchy premiums often. So that's one way, and then you just kind of have to hold your nose and realize that in the copper space in particular, there's no sort of perfect package of company, and you've got to take on either jurisdictional risk, asset quality risk and leverage, management team, might be B-, and you just got to kind of hold your nose and buy it, because there isn't there isn't a lot of options that on the super high quality level. Either that, or you go down the ETF route and buy just a basket and diversify your risk and harvest the beta. That's probably not the worst option for a lot of people. It's not something I typically do, but it's not bad for the small retail investor either.
No, exactly. If you want to play the trend, I think it makes a lot of sense. Sam, last one is going to be a cheeky one, a cheeky question here. How many silver companies have reached out for financing in the last 36 hours?
I'll have to ask my team over at Sprott Capital Partners. I haven't actually heard of any, but it wouldn't surprise me that if this continues for another week or two, we're going to probably see a plethora of financing opportunities. So, keep a lookout. We'll see.
No, fantastic, Sam. No, I really appreciate it. It was fantastic catching up with you. Thanks so much for taking the time out of your busy day. I'm sure your phone is ringing. Although on silent mode, I hope off the hook here, because I'm sure people are curious what is happening in the markets. It's been a while since we've seen two massive green days back to back. So
yeah, I think I noticed it's the fifth green day in a row on the GDX, which we haven't seen since back in 2019 at a quick skim. So obviously that boded well for the next couple of years. So we'll see. Fingers crossed.
Exactly. Fantastic, Sam. Thank you so much. And by the way, where can we find more of you? Like if our viewers want to reach out to you, how do they do that?
Best way is probably email me at my work email, which is S for Sam Broom, so SBROOM at sprottglobal.com.
Fantastic. Awesome. Thank you so much, Sam. And we'll catch up again very soon. Can't wait to maybe in Q1 next year, see where we stand.
Perfect. Fantastic. Thanks, Kai. Thanks for having me on. It's been a pleasure.
Fantastic. Everybody else, thank you so much for tuning in. We were joined by the fantastic Sam Broom. He's a portfolio manager over at Sprott Global down in the US. Fantastic insights on what is happening in the markets. And let us know what you think of the conversation. Leave a like, subscribe to the channel, leave a comment, and feel free to reach out to Sam if you want more knowledge and more information, and maybe chat with stocks with him as well. Make sure to do that. And thanks so much for joining us. We'll be back with more soon.